again. Welcome to the podcast.
Mahalo.
How you doing today?
I'm fantastic. Aloha.
Wonderful.
How are you?
Wonderful. I'm doing great. Welcome to sunny San Diego, which was your home for several years.
Not quite sunny today.
Not too sunny today. But if you look at the next several days, I think we're going to be right on target.
Good. I'm leaving tomorrow.
There you go.
I'm going home.
Well, again, thanks again for coming. I'm really looking forward to speaking with you and talking with you about owner-occupied real estate purchases and how to get the best financing. So the first question to lead off is, why would a business owner buy their building?
Great question. I'm going to answer that with a question back.
Okay.
Do you own your own home?
Yes.
Why?
Because I like the stability.
So if you owned your own business, wouldn't you want the same stability?
Absolutely.
Right? So that's the number one thing, is the stability.
Mm.
Number two is, if you have a business, you're thriving, you're doing well, and you're renting, and all of a sudden the landlord says, I'm selling the building, you got to move. Now what? I mean, that's huge.
That's a huge upheaval to any business.
Absolutely.
And a lot of costs.
Right. I mean, in your home, it's an upheaval personally.
Yep.
But for a business, multiply that times 10.
Yeah.
So just from a standpoint of operating and running your business, that's the number one thing. Not even taking into account the financial implications. But the financial implications are huge because you can buy a building, take it under let's say an LLC or some other entity that you own. The business rents that from that entity that you own. The business still has the deduction of rent, so it's no different for the business itself. But personally, you own the building, you get that income from the business, and you control the lease rate because you own both, the business and the real estate, and you get the depreciation and the interest deductions. And then eventually, let's say you have a 25-year loan, eventually you're going to own it outright. And then all that income, there's just nice income for retirement.
Absolutely.
And then maybe you eventually sell the business, so it's a retirement tool, and you just keep the building.
Yeah. Yeah. Well, the one difference between owning your primary residence and owning the building from which you operate your business is that most people will remain in that primary residence for their entire life.
Right.
Where when you own a building from your business, that is not the case, because most people do not operate their business until the day that they move on, right? They exit the business either by selling it or even if they just shutter it.
Right.
And so like you said, right, if they have that building and that income stream, they can determine whether or not they want to sell the building when they exit the business, or they could just keep it and they could lease it in perpetuity as a great investment vehicle. And so though the SBA doesn't like people to call it an investment vehicle, in the short term, it has utility.
Right.
But in the long term, it is definitely a sound investment strategy, because people, again, when they buy their home, they need to live in it.
Right.
And like right now, very few people are trading their homes because here in San Diego especially, prices have skyrocketed, where most people in San Diego County, they couldn't even afford to buy their home today if they had to.
Same thing with their building.
Absolutely. But now if they exit the business, then they can sell that building and reap the reward of either the sale or the lease.
Right. So you have
Absolutely.
two choices.
Two choices.
And I know many businesses that have sold the business, kept the building, which is fine. For SBA, if you're talking through the Small Business Administration, they're okay with it as long as it's not the intent. You don't do it like the next year.
It's not a flip.
No.
Yeah.
You go down the road and life changes, and 10 years later, you end up selling the business and keep the building. That's fine. SBA is totally okay with it.
Yeah.
But I also know people that sell the building, and they're going to make way more from the building than they do with the business sale.
That's a big point you bring up, that the real estate they own has the potential to have more value than their business.
Right.
And that's because
it's going to appreciate faster than your business does.
Exactly, because some people, let's face it, they don't necessarily understand how to properly exit their business, but you don't even have to know how to exit your real estate because it's there.
Right.
The market does it for you. That's beautiful.
Yeah. So it really is a win-win. And even if you don't do that, you just keep it. And in 25 years, let's say you buy it when you're younger and you keep the business, and you keep the business for 30 years. Well, from year 26 to 30, you have no mortgage.
There you go.
So the business might be paying you rent. Great. That's just extra income.
It's a deduction still.
Right.
And it's still income to you personally.
Exactly. And you have a ability to write stuff off too.
Absolutely.
But if you were renting, you're just at the whim of the marketplace. And oh, by the way, do rents go down?
Let me check in San Diego. That's going to be a big no.
Correct.
Rents do not usually go down.
If you have a fixed rate loan, your payment stays here.
That's right.
Versus the rent. Now, you can increase the rent to yourself. That's fine, which means you can make a little extra something, something. So it is a nice investment tool. And SBA recognizes that.
Absolutely.
I mean, I go back a long way. Back in the day, they didn't. When I started 34 years ago, they didn't allow you to be able to buy a building and put it in another entity. You had to buy it in the business itself.
Interesting.
Then they created the alter ego rule, and eventually it became what is now, which is the eligible passive concern, where you can form an entity, and they actually encourage you to do that.
Absolutely. I almost do that on every deal. I mean, I would say that unless it's a gas station where the going concern and the real estate are tied and the borrower wants to do it in the going concern, almost exclusively it's in an EPC and an OPC being the operating company, paying rent to the EPC, the eligible passive concern. There you go.
Exactly. And that's the magical thing. And the federal government understands. They've come a long way. And it's nice to see that change to what we knew was reality. And now they're like, yeah, that's just normal course of practice, and that's what you should do. They encourage it.
Absolutely.
Yeah.
So let's transition now to the 5. We talked about this.
Yeah.
5 different ways. Now, 3 of them are probable and plausible, 2 not so much, but we want to make sure that we're comprehensive. So the 5 possible ways a business owner, if they don't know right now, can buy their building, can buy the real estate from where they operate.
I like to tell people that you do have options. There's people in lending that say, okay, here's your option. I'm like, no, I'd rather tell you all the options. So not many of them are you're going to do, but option number 1 is to pay cash. Well, if you're buying a $4 million building, if you happen to have $4 million lying around, great. But most people don't, and they probably don't want to. You probably want to leverage it and use your money in the business because you can get a better return than you can from borrowing.
Absolutely.
So that's number 1, short conversation. Second one is have the seller finance it. That's probably an even shorter conversation because most sellers are selling because they want the money. They want the money to go do whatever they're going to do.
That's right.
Right? So those 2 are pretty quick conversations. The third is to get conventional bank financing, which is fine, but it's typically nowadays 25% down, 30% down. And it goes back to that, well, what's a better use of my money if you have the 25 to 30%? And if you do, is it a better use of your money to put that as a down payment, or you're better off using that as working capital in your business?
Yeah.
So most people would rather put as little down as possible.
And there's 2 misconceptions with conventional financing that I hear when people call me. Ryan, should I consider conventional financing since it will be an easier loan package, quicker process, and lower rate? And I share with them, that doesn't necessarily equate.
Right.
Conventional financing doesn't mean quicker or lower rate. I said, they're still bankers.
Right.
They need your information. They're making a credit decision. Oh, and by the way, if they're making that decision conventionally, do you think that's an easier decision for them without an SBA guarantee or a more difficult? So you might even have to provide more paperwork and it might take longer because you got to go in front of a credit committee. So that's those are 2 misconceptions that I see.
There's a third, and that is almost exclusively a conventional loan might have a 25-year amortization, but it's almost always going to have a 5 or 10-year call.
That's right.
Which means the loan is due, or you have to re-up it and do everything all over again in 5 or 10 years.
So it's not fully amortizing. And I know that's not a phrase that a lot of people who are watching this will know, but I say that all the time. And one of the benefits of an SBA loan, so a 7A or the 504, the debenture, is that it's fully amortizing. And like you said, where a lot of commercial banks make their money in commercial real estate is when they require the maturity. It's not a 30-year fully amortizing like it would be in the residential space, but there's going to be a 5-year, 10-year, 15 max, but usually it's 5 or 10 maturity, which means that you go through an underwriting.
Conventional is usually 5.
and it goes through an underwriting period at the incumbent lender or incumbent bank. So
Right.
they're determining whether or not they want to renew you. It's not an automatic renewal.
Right.
And another thing with conventional, now that we're talking about it, a fourth thing would be that there's typically going to be covenants associated with it.
Right.
So you're going to have debt service coverage ratio, debt to tangible net worth, collateral covenant. They might even say, hey, we need to reappraise your property at the maturity. So you're going to be spending more money every 5 and 10 years.
And you're at the whim. I've seen banks really want to basically kick people out of the bank
Yep.
because of the type of industry.
Yep.
Well, when you do a long-term, especially when you have it fixed, you don't have to worry about that.
That's right.
So with the SBA side, on a 7A, it's a 25-year fully amortized.
Yep.
Typically variable rate. On the 504, the first mortgage, we'll get into this in a second, the SBA actually requires the first mortgage to have a call no less than 10 years.
Yes.
So the minimum would be, say, a 25-year AM due in 10. Most of the time, it's a longer term. I mean, you can get 25 years fully amortized, which means you don't have to worry about it at all. And you can get a rate that's fixed for your choice. 3, 5, 10, 15, 20, 25 year. You can do a 25-25. And when we get into showing example of a 7A and a 504, you see it on paper side by side and you go, whoa,
Yeah.
I can set it and forget it.
Yep.
25-year fully amortized. So the last two options that we sort of just talked about, but are the two SBA options,
Yeah.
7A and 504.
Yep.
There is a sixth, and that it depends, after sixth and seventh. It depends. The USDA has a program,
Yes.
depending for rural areas, that's similar to the 7A, but it's a bit of a niche because it's in rural areas. And the seventh is there are some programs for minorities or in a new market tax credit area that could do less than 10% down, like a 5% down.
Got it.
Rate's going to be higher, but there are those nuances that are possible. It's not necessarily as common,
Yes.
but when we talk to borrowers and figure out their situation, usually it's, tell me a little bit about what you want to do. Are you growing your business? Are you in something that you're going to be in 10,000 square feet tomorrow and you expect to be in 25,000 square feet in 2 years? Or are you going to be in this for a long term? And you try and fit that program to meet the needs of what the borrower wants.
Absolutely. Yeah. Yeah. There's another one, private money. Sometimes private money is used when there's a need to acquire the property quickly.
Yep.
And then you can even refinance it right after the close of that private money
Use
loan.
it as a bridge.
Use it as a bridge.
Yeah. Because typically an SBA loan is going to take minimum 30 days, but typically it's 60 days. And sometimes people are in situations where like they need a quick close. So you could either use private money or hard money to do that quick close. And then you can take that out with one of the other, like a 7A or 504.
Yeah. Yeah. And so talking about the 7A, like you had mentioned, typically they're going to be quarterly adjustable.
Right.
So those are going to be those interest rates are going to be able to adjust as the Fed changes the Fed fund rate. So we talked about
the Fed fund rate affects prime.
Prime. There you go. Way to tie it there. Prime. So during the COVID period, the Fed fund rate was effectively 0 to 25 basis points, which means the prime rate was approximately 3.5. And then if you go 2.75% above that, right? Now you're looking at a rate in the 5s and 6s. And so there were a lot of businesses who bought real estate with an SBA 7A quarterly adjustable.
Right.
And then when those days were over,
like now,
right? The prime rate is 7.5. And when the Fed started to bump up the Fed fund rate,
you're in double digits.
We got to a high of 8.5% prime rate.
Yep.
Which was effectively in the 10%, 11%.
Yeah.
And so I know that there were people who were calling me, hey, Ryan, what can I do? And then that leads to what a lot of people were looking to refinance into, which was the 504.
Exactly.
Because the 7A, and I want you to elaborate on this and stretch your legs on this to make sure that borrowers understand the difference between the 7A pricing and what it's based on and the 504. So take a few minutes to stretch your legs on that.
So first of all, so that your listeners, viewers understand, because not everybody does. Most people think there's one SBA loan. They just hear SBA.
Yep.
There are not. There's there's at least two. I mean, there's other products for non-real estate, but the 7A and 504 are the two products, but they're so completely different. The way the 7A works is a bank or a non-bank lender makes the loan for, say, 90%. Somebody puts 10% down. They make a 90% loan. The government gives a guarantee for 75% of that loan. The government's not lending the money. They're guaranteeing 75% to the bank. The bank is making the loan based off of prime plus whatever you negotiate. Now, typically prime plus 2 3/4 is the norm. They can go higher. Now they can go up to 3.5.
Wow.
But oftentimes you see it depends on the strength of the business. We talk about in lending risk-based pricing. So the stronger the business, the stronger the credit, the lower the rate. So 7A is typically 2 to 3 over prime. One thing that's super important is most people that I talk to are saying, oh, well, rates are coming down. It's like prime may come down. It did come down off of 8.5.
It did.
But I don't know how much more it's going to come down. It may. Depends on what happens with, our new presidency and so forth. But the prime rate and treasuries are completely different animals.
Yes.
And what's really interesting is prime's not really meant for real estate. Prime rate is meant for banks to lend to consumers.
Short-term HELOCs.
Yes.
Lines of
Equipment.
credit. Yeah.
Yes. The 7A program is a one-size-fit-all program. You can buy a piece of equipment with it. You can do inventory, buying a business. You can also buy real estate.
Yeah.
Well, the prime rate is for any of those. So the banks use the 7A for all those different types of needs, uses of proceeds, but it's always prime plus. The 504 program is based off of treasuries and specifically 10-year treasuries. So the way the 504 program works, it's also 90% financing. And when the program came out, it was a way in which to leverage the dollars so the government was not at risk for the whole 90%, or not even the 75% guarantee like the 7A. So the way it works is a bank would do 50%. So take $1 million building. Not that you can buy that much anymore, but $1 million. But we'll just use that.
We might be able to buy this studio for $1 million.
Maybe. Okay. So we have a $500,000, 50% first mortgage that a bank would do, or a lender. The SBA comes in and says, we'll do 40% in second position, and the borrower does 10% down. The SBA second, they don't actually lend the money directly. They use these nonprofit entities called CDCs, not Center for Disease Control.
That's right.
During COVID, that was really an interesting time.
I know.
But certified development companies, and there's about 225 active across the country. There's, I think, 20 some in California. California is a very popular market for small business. Anyway, the CDCs are doing these second for SBA. And what happens is they gather all the loans that are approved every month and they sell a bond on Wall Street. And that bond is guaranteed by SBA. It's kind of like Fannie and Freddie. So they're selling a bond on Wall Street to investors. The investors are basically saying, I can invest in the full faith and credit of the U.S. government. I can go invest my money in treasuries, or I could invest in this 504 thing. It doesn't really matter. It is a full faith and credit. So they want a price above treasuries because they can go do treasuries at 4 1/4. Well, they want a spread above that because they're taking a little extra risk, not much, but because they don't really know what it is, but it's backed by the full faith and credit of the government. So they're selling a bond on Wall Street. That's how the loan actually gets funded. And just as an interesting, depending, it doesn't really matter what your political nature is, the 504 program has what's called a zero subsidy, which means it doesn't cost the taxpayer anything. There are fees built into the loan program that pay for potential losses in the program.
There you go.
So that's a really nice thing. And now it's an interesting time because they're talking about cuts. And the only thing they're cutting is they're cutting like government offices and personnel. It's not the loan program because the loan programs, we've created a zero subsidy so it doesn't cost the taxpayer, which is good. So we're not afraid of being cut.
In the government, we call those self-funded programs.
Yes. So that's the second. And by the way, interesting enough, the second is almost always cheaper than the first. Like, wait, why? They're in riskier position. But it's because it's a government guarantee. So right now that debenture is what it's called. The second is about 6.25%. And that's a 25-year fixed. And the interesting thing about, I just talked about risk-based pricing. Well, on the SBA 504 second, it's one size fit all.
It is what it is for everybody.
Yep. If you barely qualify,
you get it.
Or you're golden,
you get it.
Same thing.
Yep.
The first mortgage is risk-based pricing. So that's when a lender will look at and say, okay, I'm going to lend in first position. I'm at 50%, which is a fairly safe loan. But the rate and term is going to be dependent on the quality of the credit, the collateral, the business, the character, so forth. And it could be a variable rate all the way up to a 25-year fixed rate. So I work on the wholesale side representing a little company called Morgan Stanley. You've heard of them? And another little company called New York Life. I don't know if you know them. 25-year fully amortized fixed rates in the sixes. So you can get, say, a first mortgage at 6.5 fixed for 25 years. The second 6.25 fixed for 25 years. That's pretty phenomenal.
Now, Ken, I am an older gentleman now.
You are not.
But I don't remember 20% interest rates. How good is historically? How good is a 6% interest rate? I mean, how many people who are in their 60s, 70s would say, "Hey, I remember back when interest rates were X, Y, Z, 15%, 20%." Right. And now people are looking at 6%. They're like, "Oh man, 6%." And it's because they remember the 3% days.
Yep.
We'll likely never see those again.
So here's the story that I tell. So I've been doing this for 34 years. So I can't really get away with saying that I'm 39 years old. I'm a little older than that, but I've been around a long time. And I'm a surfer. So if you ever watch a surf competition?
Yeah, of course.
So the scores in surfing, they take the low and throw it away, and they take the high and throw it away. And they average the remaining scores. I look at rates the same way. COVID was the low.
Throw it away.
Throw it away.
Throw it away.
The 1980s?
Throw it away.
High.
High.
If you look at a graph over the last 40 years, 10-year treasuries were in the fours. That's where we are now. It's fairly normal. So people that say, "Oh, I want to wait until the rates come back down." Come back down to what? To COVID rates?
Not going to happen.
No.
No.
So rates right now in the mid sixes is really good. I mean, as long as treasuries stay in the fours, this is a great time. Great time. I don't see them going lower than 4. I also really don't see them going higher than 5. They're going to stay in that belt in the 4s. Now, it may swing a little bit. I mean, the market the past few weeks has been kind of crazy. Now, when the stock market goes down, treasuries also fall, which is interesting because we didn't talk about prime. There's nothing to do with it. That's only when the Fed changes stuff.
Yep.
And that only affects the variable rate, which is typically the 7A program.
Got it. Let's talk about the program that you're representing right now so that people understand what is available to them through your program. And let's talk about what that business looks like that qualifies.
Yep. So I mentioned risk-based pricing. So Morgan Stanley, New York Life are more traditional type of lenders. Now, they're not banks. So one of the beauty is that there's no banking relationship required. Okay. So you have a small business, you bank wherever you bank, you continue to bank there. They're looking at to get rates in the 6s, they're looking at what we call multi-purpose properties.
Okay.
And if you're a golfer, do you hit it down the fairway? Say yes.
I like to.
That's what they like, down the fairway.
That's right.
They don't want stuff that's going off into the rough and into the trees. So their philosophy is, if we had to take the property back, we don't want to, but if you have a troubled business and we have to take the property back, we want to be able to sell it to anyone. So we really like boxes.
Yeah. So let's do a speed round here. Is a gas station a multi-purpose property?
No.
That's not.
Single purpose.
Single purpose. How about schools built to be a school?
A school can be considered a multi-purpose.
Okay.
Because typically, unless you have a ton of those tiny toilets, schools can be turned into something else.
Wonderful. What about car washes?
Single purpose.
What about office?
Very multi-purpose.
Warehouse?
Love it. Multi-purpose.
Love it. There you go. Thank you for doing that.
Wait, keep going.
Light industrial.
Multi-purpose.
So that would be office with a little warehouse in the back.
Kind of what we're sitting in now.
Yeah.
Yep.
Yeah. So great. Well,
Keep going.
that's all I can remember.
Here's a couple that are interesting.
Okay.
Restaurants.
There you go.
So restaurants, SBA considers multi-purpose.
Oh, interesting. Even with a drive-through? Or especially with a drive-through?
They do. It's
Okay.
like we don't.
Interesting. Okay.
So we would tend to not lend to restaurants because it's harder. Now, I do know lenders. I can get a restaurant done. Rate's going to be higher because it's a riskier business.
Yeah.
Here's a really interesting one. Self-storage.
Self-storage.
Not only does SBA consider self-storage an active business, which I'm like, really? Okay.
Which is usually managed by approved management companies through the SBA. So it's not necessarily an active business to the business owner.
Well, they consider it active.
It's amazing. It's great.
Isn't it? Not only do they consider it active, they consider it multi-purpose.
Wow.
We don't.
Okay.
Because if we have to take back that kind of collateral, who are we going to sell it to? Another operator of that kind of business, and that's it.
Yeah, it pigeonholes you.
Yes. And so that would be considered multi-purpose by SBA, but we consider it more of a single purpose. So you're not going to get the pricing fixed in the sixes for that. So you can see that it depends on, we've only talked about collateral, but the collateral aspect is a major component. The second major component is your credit. Do you have good credit? Do you have credit? So we'll go down to 650 as a FICO score with our New York Life product, which is pretty generous.
I mean, I think that's really generous.
It is.
But it really has more to do with what's behind the score.
Right.
How do you guys look at that?
So if, let's say you had a mishap 10 years ago and you had a foreclosure on something, we're reasonable. Whereas a Morgan Stanley, their philosophy is a little bit stricter. They'd be like, nope, not interested.
Okay.
So it's nice to have the ability to say, it might not fit this program, but it'll fit this one. And with us, it's only a 25 basis points difference. Means 0.25% from an interest rate, say 6.5 to 6 3/4. Not a huge difference. But if you qualify for Morgan Stanley, for example,
do it.
Yeah. Debt coverage. So it's a technical term, but it means how your ability to repay. So if we look at your financials and your tax returns and you can make it, but you have nothing left over. You just break even.
1-to-1.
1.0. That actually qualifies for New York Life.
Wow.
Morgan Stanley wants you to have a 20% cushion.
Okay.
So 120, 1.2. Most of the big banks, Wells, Chase, B of A, they're going to be like a 1.2 or a 1.25.
And they're going to add a rate constant. So they're not going to use the par rate. They're going to increase the interest rate to approve that internally.
Correct. So what we look at is I nickname our New York Life program a near miss, which means you might bank at B of A and it's a good deal, but not great. The debt coverage may be a 1.1. Not quite going to make it for the big guys. Well, we can do those transactions and you all day long and you keep your business where it is. We'll just do that transaction.
They're in the low sixes right now. So you guys are not far off.
Right.
But the fact that they could qualify with you is huge.
Right.
Because the upside, again, that we've talked about owning your building is big time for people.
And the other thing that's interesting is I'm a wholesale with New York Life and Morgan Stanley. So typically a small business would go to their bank, a community bank, and the community bank would come to us and raise that rate because we're wholesale. Well, your listeners are going to get wholesale pricing. All they have to do is call you and mention Kauai.
There you
That's
go.
where I live. And they can get wholesale pricing.
There you go.
Skip the bank.
Skip the bank.
Go to the front of the line. TSA pre-check.
Come to ThinkSBA, get wholesale pricing.
It's like clear at the airport.
There you go.
Yeah. Go to the front of the line.
There you go.
The other thing that's interesting is, so I've been doing this, like I said, for 34 years. So I know you bring me a transaction. I'm going to tell you, here's all your options. And if we can't do it, I'll never say no unless it's equipment. It's about the only thing I don't know who, right now it's very tough to finance. But even a car wash or a hotel, there are lenders that do it. And I happen to know who they are and I'll happily place you in the right direction.
Got it. Yeah, that's great. So as we wrap up, what I like to do is walk a business owner through the process. So a lot of people who are watching and listening They've never bought a building.
Sure.
They're a little bit intimidated.
Yeah.
Walk them through the process of preparing to send you a loan package for review.
Yep.
What are you going to be looking at? So you've already talked about cash flow. You've talked about credit. You've talked about collateral. What are some other things that they need to be prepared for? And I'll lead you in a direction. A lot of times business owners aren't ready with their profit and loss statements.
Right.
Or they have tried to mitigate their tax burden by lowering their taxable income as far as it can go. How do you review that? How do you approach that? And then how do you process that?
So I actually make it even simpler. In the very beginning, before somebody sends me anything, I ask for 3 items and 3 items only. What's the use of proceeds? What are you doing? Are you refining a building? Are you buying a building? Do you want to do improvements? Are you buying a building with improvements? Just tell me what it is and how much. That's number one. Number 2, what's your business website? Because I want to take a look and see what kind of business it is. And if you don't have a website, well, typically that's a red flag. But
these days especially.
Right? The people here could probably create one for you.
Absolutely.
But I want to look and see what kind of business it is. And therefore, I can tell very quickly what bucket it fits in. Because every lender has their own nuance. And instead of me explaining to you every little nuance, I can tell you in 3 minutes by looking at somebody's website and seeing what fits.
Okay.
And the third thing is, what's the property address? Because I'm going to Google Map or LoopNet the property and take a look at it and say, okay, this fits or this doesn't fit this lender. In my case, I'm looking at Morgan Stanley and New York Life and City First, et cetera. I'm going to look and see what fits. So those 3 things, and I can tell you in 3 minutes, if I'm at my desk, okay, we can move forward with this type of program because it fits. Then we'll get into a little bit more of the nitty gritty like you're talking about. And what we look for in the very beginning is simply the last tax return.
So 1 year.
1 year. So I want your 20, if you've filed your 24, great. A lot of people haven't, but let's just fast forward, depending on when they watch this podcast. They filed the 24 tax return. Great. Your 24 business and personal tax return. A personal financial statement. And we have a form if you want to fill out. SBA has this generic form. If people want to fill it out, fill in the blank. That's fine. A business financial statement. That's like a QuickBooks statement. Everybody's got some. Most people use QuickBooks. Yeah, go to their most recent, hit the button, and we want to know what kind of debt you have and your payments on your debt. And back of a napkin, I can tell you in 10 minutes if you're in the ballpark.
There you go.
For example, people ask me all the time, well, give me, what's my monthly payment? Average right now is around $6,000 per million.
There you go.
Just a quick and easy. So I could say, Ryan, is your business profitable? You're like, we break even. All right. You pay yourself a salary that you can live on? Yeah. What's your rent? If your rent is, say, $12,000 a month, well, that's about a $2 million building.
There you go.
Like, well, I want to buy a $10 million building. Well, then you're going to have some excess profit or depreciation or things that we're going to look at to be able to afford that. But in 3 minutes, I can qualify somebody back of napkin. If somebody says, yeah, I lost $500,000 last year because whatever, I'm like, maybe not the right time to buy a building.
That's right. Yeah. Yeah. I always ask people when they lose that kind of money, is that a cash like a cash loss? Like there's money out of your bank account, or is that a paper loss?
Right.
Yeah, that's something big.
Loss carry forwards, depreciation.
Yes. So here's the next question. So let's say I want to go buy my building and it's move-in ready, but I want to put my logo inside. I want to paint the walls. I want to put in new carpeting. Maybe the architect says you need to move, which I've had this happen. You need to move your plumbing from here to there to accommodate what you want to do with your offices. How does your program approach tenant improvements?
Yep. So I look at it in 4 different aspects. Straight purchase, no improvements.
Yep.
Slam dunk, easy. Everybody does that.
And when does the debenture close? So I know the answer to this, but I want you to answer this. So for example, if it's a straight purchase, I close, when will the SBA close the debenture? Because that's something they have to realize. And then if you could talk about how that interim loan floats out there until it does close.
Right. It's interim or bridge loan. And as confusing as all get out, I understand it. So what happens is the first mortgage lender, bank, TPL, it's called a third-party lender. is going to close the first mortgage. The SBA approves the second through the CDCs, but they only fund their loan once a month. That's when they, remember I talked about selling the bond.
Yep.
They sell a bond and it's typically about 60 days later because there's a cycle in order to gather all the loans that are approved all across the country and sell the bond. So if it's a straight purchase, no improvements, they're going to sell that bond 60 days later. But you need to close now. So we use an interim lender or a bridge lender. Typically it's just an interest-only loan to cover the CDC basically in the SBA to close. And almost always it's interest only and it can be financed. So it's actually cheaper for the borrower because they're only paying on the first until the debenture funds 60 days later.
Got it.
If there's improvements that are cosmetic only, everything except for the plumbing stuff in your example.
Because that would be permits.
Correct. You can do the same thing.
Okay.
If it's cosmetic only, they can go straight to debenture 60 days later. If there's improvements involved, they're going to have to wait until the improvements are done to sell the debenture. We'll still finance all the improvements. So you're buying a $1 million building and you're putting $100,000 into it. Now your project is 1.1 plus soft costs, which we will finance all the soft costs. Every transaction has it. Think about you bought a home. Think all those other costs that you had to pay for out of pocket. We don't. Our programs will allow both 7A and 504. You'd include all the soft costs. So that's appraisal, title, escrow, any fees. All that is financed. So we create what's called a total project cost, including the improvements and the purchase price of the building. 90% financing, so you're only putting 10% down.
Got it.
If there's major improvements over like 25%, let's say you're buying a $1 million building and you're putting $700,000 into it, you're really blowing the thing apart.
Yeah.
Then it becomes more of like a construction loan. Your hair's gray, it'll be a lot grayer and you'll have a lot less of it. Construction loans, I mean, it takes a lot. Or worse yet, you're going to buy land and build a building.
Yeah, it's huge.
It's a lot of work.
Undertaking.
It's a big undertaking. And, you know, in San Diego, for example, you really don't need to do that.
No.
There's plenty of buildings around unless you're doing something very, very specialized.
Yeah.
But most people don't need to. So those are going to take longer. You can get a construction loan. Now, the risk is the debenture, the SBA part, is not going to fund until you're done with construction. Your construction might take 18, 24 months. I have a good crystal ball, but not that good. I can't tell you what your rate's going to be in 2 years when you're done building the building. It's probably going to be higher. So there's a real advantage in buying an existing building and doing whatever you need to do to fit your business to it.
Yeah, but not too big of a project.
Yeah, don't go crazy.
Don't go crazy.
Yeah.
Will your program close on the purchase contract date?
Yep.
Even if permits are required, but they don't have permits yet?
Yeah, so we're going to take all the improvements unless it's large.
Okay.
In your first example, got to move a couple walls and plumbing, and maybe it's $100,000 out of $1 million. So it's 10% of the project. We'll close on the first.
You
right
will
away.
close on the first.
And then interim loan will close. So you'll have your 90% financing at close. So you're ready. You're not going to move in the building probably. You might.
Yeah.
I mean, if you want to live with it while it's being improved, you can. Sometimes you can, sometimes you can't. Depends on your current lease. But we will close on the contract date.
That's great. Yeah, I appreciate you sharing that with us because that's a real life scenario I'm going through right now. You're going through right now. I'm sure that as you look back at the number of deals you financed, you have probably financed thousands. I mean, that is not embellishing. That you have financed thousands. Can you talk to us about some recent or most notable transactions that you've done that will give people a real sense of how you do what you do and what you do? Sure.
So I was in San Diego for 25 years. I live now in Kauai. Ask me why.
Why?
Because I can.
There you go.
Because now I cover the whole country.
There you go.
So I'm doing deals in all 50 states.
Wonderful.
But while I was in San Diego, doing deals just in San Diego, I financed 100 deals a year.
There you go.
Well, you do the math. You're right. It's in the thousands.
Thousands.
And the fun thing about what we do is, there are many deals that I do that or have done that are businesses you're like, you don't even think about. The first 504 loan I did in 1991 was for a company that manufactured stoplights.
Wow.
Do you ever think about who manufactures or makes a stoplight? You probably never thought about it, right?
Never thought about that.
But everything you see, the shirt you wear, the table, the microphone, the computer, everything is made by somebody. And it's kind of cool to think about that and to be able to have financed all these types of businesses. And then there are the fun ones. I mean, we've probably financed 24 microbreweries in San Diego. And that's fun because they're household names.
Yep.
I'm a surfer. So my favorite deal was Rusty Surfboard.
There you go.
So if Rusty's watching, hey, Rusty. I actually had, back then it was a 20-year loan, and he took it all the way, 20 years.
Wow.
It was a small, started off as a 1,500 square foot little shaping room and bought a bigger building. But I mean, that's a fun one. Some of the microbreweries, people would know, the Carl Strausses. They're going to be like, oh, of course they know it. And that's kind of fun.
Yeah.
When you talk about the types of businesses that they're recognizable, right? Yeah. What's your favorite beer? We probably financed it if it's local.
So Ken, I really appreciate you sharing that with us.
Yeah.
And appreciate you being here. We're coming up on our time.
Oh,
we've covered a lot of information that'll be helpful for those who watch this. And thanks for visiting.
Absolutely.
You're going to come out. Rest of your day.
You're going to come out and visit me, right?
I would. I would love to. In fact, we're talking about putting it on the calendar right now.
Right on.
Absolutely.
Yes.
Go have some sushi in Hanalei.
Yes.
Because I think that's the best toro I've ever had.
There you go.
Was at a sushi bar in Hanalei.
Probably the Dolphin.
I mean, it's in that little strip center, right?
Yep.
Absolutely.
Yeah.
That is the best toro I've ever had.
Yeah.
Awesome. Thank you.
Aloha. Mahalo.
Yes, sir.